Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing today?
Doing great. It's a pleasure to be here, Ross.
Yeah, it's great to talk to you, and fortuitous as well. There's been a lot of market activity around the Fed and Fed hawkishness lately. But I want to zoom the conversation out a bit from just short-term interest rates, which the Fed controls, to the broader package of financial conditions, right? So looser conditions are more stimulative for the economy, and tighter financial conditions have the opposite effect. That has been up and down over the summer, and they've recently tightened a bit as the Fed has gotten more hawkish. But I wanted to get your thought on how you look at financial conditions, what you're seeing now, where they're headed, and what that means for the broader economy.
Yeah, well, it's a great question because we've often argued at Strategas that financial conditions need to tighten if the Fed is going to be successful in one, bringing down inflation, and two, bringing it down without putting the entire burden of monetary tightening on Main Street USA. That is, you're going to have to see some tightening in financial conditions, which will therefore lead to a reduction in government spending, a reduction in spending from high net worth individuals, and even some reduction in business spending. And without that, all of the burden of monetary tightening falls on Main Street. So we've got to see this happen. And what's interesting is in the month of August, throughout most of August until about last week, you saw financial conditions actually easing. That is, easing despite the fact the Fed is well deep into its tightening cycle. And there's some technical reasons for that, but this didn't go unnoticed by many folks. So I think there are members of the Fed who are glad to see conditions are tightening again as we head as the calendar turns towards September.
Yeah, absolutely. And, the Fed has multiple ways that they can tighten policy and tighten financial conditions. Interest rates get a lot of the attention, but they also have balance sheet runoff or quantitative tightening. The Fed bought a lot of bonds over the last couple of years, and they need to let those run off their balance sheets. So that activity is ramping up over the next couple of months, and I wonder what your broad outlook for balance sheet runoff is and how that might impact the fixed income and equity markets.
Yeah, well, it's a cliche to say, but I think it's worth repeating again here, and that is we're watching the 10-year Treasury yield, and this even more so in the month of September, because as you mentioned, balance sheet reduction is now ramping up in September. That is, you're going to see the Fed presumably double the pace of balance sheet reduction depending on the pace of maturities in the mortgage portfolio, and that is going to cap at about $95 billion per month in September. Well, that's significant because now you're seeing legitimately the market has to soften, that is, the bond market has to soften to make room for what is going to be a modest increase in net Treasury supply. And the 10-year Treasury is the area to keep an eye on. So that's what we would clearly be watching. And you're seeing that this morning as we're speaking right now. 10-year Treasuries are making a move towards 325. You got to remember earlier this year in June, they hit 350. So the question will be, can 10s push up to that 350 again?
And so with this broader macro setup that we've discussed today and where you think yields are headed from here, how are you positioning fixed income portfolios heading into 2023?
Yep. So for the short end of the curve, you really it's a matter of where do you think the Fed is going to terminate the Fed funds rate. Now, right now, the market is taking recent Fed hawkishness to mean that Fed funds rate is going to terminate somewhere around 4%. So you should see twos continuing to make a meander towards 4% level and maybe even shoot a little bit above that. What that means, though, for 10s is we've probably have seen the peak in 10s for this year. And if we haven't seen the peak, it's not going to be much higher than the 350 we hit in June. And then at some point in time, as the market really has to deal with the reality that a recession is coming, you're going to see 10s again begin to dip lower. And I wouldn't be surprised to see 10s actually move back below 3%, albeit not by a huge amount. So we're looking at 10s making another move here higher as September progresses and as the market kind of makes a concession here for balance sheet reduction. But then those recessionary headwinds are really going to start to push 10-year yields back down. And I do think we're going to make a move back below 3% before the end of this year.
Yeah, absolutely. Well, I'd love to get your insight there and your outlook. So on the shorter end of the curve, we've seen 2-year yields basically push to a new cycle high alongside Fed hawkishness. But you mentioned the 10-year, and I'm wondering, just for the broader yield curve, short-term yields, intermediate-term yields like the 10-year, what's your outlook heading into 2023 for where those might go?
Yeah, and so we're actually about neutral on a duration basis versus our benchmark, that is the Bloomberg Aggregate Index. So we're about neutral. We still have a slight short duration heading into September. And if we do see tens move out to that 350 level again, we would probably cover that short and move to a full duration neutral. We don't see a whole heck of a lot of value, though, in really much of the fixed income space, with the exception of short duration corporates, which typically are a safe haven under a fairly wide range of economic scenarios. And by short duration corporates, we mean roughly 1 to 3 year investment grade corporates. In terms of value within the investment grade corporate treasury agency space, we see most of that value now on the really short end, 1 to 2 year part of the curve, because that's where the most yield premium versus the expected path of the Fed funds rate is priced in. So you're really seeing a downward sloping curve for the most part from 1 out to 20 years. And you're seeing that value really concentrated in the front end of the curve. Another interesting thing, though, I'd say, is that the curve has got multiple inversions, which is a really tricky macroeconomic signal to interpret, and one which we interpret to mean that the market is still pricing in rate cuts somewhere between 18 to 24 months from now.
Well, Tom, this has been super helpful. I really want to thank you for your time. And as fixed income markets evolve, we'll hopefully talk to you again before year end. So thanks again.
Sounds great. Thanks.